The headlines have moved on, public attention has shifted, official statements have concluded, yet from a structural perspective, the events surrounding Venezuela may be better understood not as an isolated episode, but as the opening phase of a longer and more complex systemic process. This is not best examined as a legal proceeding, nor as a narrative centered on individual leaders. It is more coherently analyzed as a systems-level interaction, where law enforcement framing, military capability, financial pressure, and resource control intersect within broader geopolitical competition. Rather than focusing on personalities or stated political motivations, this analysis steps back to examine structural incentives. It considers how an operation publicly described in narrow terms could also be situated within longer-running dynamics involving energy markets, payment systems, trade routes, and the mechanisms through which global power is exercised and contested. From this vantage point, recent events do not appear sudden. They may be interpreted as the visible endpoint of accumulated pressures, tightening sanctions regimes, constrained financial channels, shifts in global energy flows, and the expansion of non-Western economic engagement across Latin America. Venezuela's strategic relevance did not emerge overnight. It arguably accumulated as other constraints narrowed. One analytical question is why decisive action appeared to occur at this moment rather than earlier. Another concerns why issues such as oil denomination, currency settlement systems, and external economic partnerships appear repeatedly in background reporting, even when official rationales vary. In many historical cases, discrepancies between public explanations and structural incentives have proven analytically informative. Across much of the media environment, coverage has emphasized operational spectacle, special forces, rapid execution, and tactical success. Historically, such focus often diverts attention from financial and economic variables that tend to exert longer-term influence. In prior interventions, concentrating on the operational dimension has frequently obscured underlying balance sheet considerations. From a structural standpoint, the operation can be examined less as an ideological campaign and more as an attempt to manage accumulated economic risk. Throughout modern geopolitics, a recurring pattern has been that prolonged sanctions against resource-rich states tend to generate adaptive responses rather than compliance. Over time, those adaptations can reduce the effectiveness of the sanctioning power itself. For more than 2 decades, the United States applied escalating pressure on Venezuela through financial restrictions, asset freezes, recognition strategies, and support for opposition structures. Historically, such measures sometimes succeed, but they also frequently lead targeted states to develop alternative trade, shipping, and payment mechanisms. The point at which coercive leverage diminishes has often preceded shifts toward more direct forms of power projection. Energy markets form a central variable in this analysis. While the United States produces substantial volumes of oil, industry data consistently distinguishes between light sweet crude and heavy sour crude. Many U.S. refineries were historically configured to process heavier grades. Structural mismatches between production profiles and refinery capacity have, in past decades, shaped import dependencies regardless of aggregate output figures. This creates a technical constraint rather than a political one. In previous periods, such constraints were mitigated through stable relationships with heavy crude exporters. When those relationships become less predictable, strategic calculations can shift. Analysts have often noted that energy security debates hinge less on total supply than on compatibility and reliability. Another factor frequently cited by energy economists is the use of strategic petroleum reserves. Historically, large drawdowns have tended to reflect acute market stress. Replenishment cycles, when delayed, can reduce flexibility during future disruptions. Whether reserve levels materially constrained policy choices in this case remains an open analytical question, but precedent suggests such considerations rarely operate in isolation. At the same time, global oil markets are influenced not only by volumes, but by pricing mechanisms. For decades, most oil trade has been denominated in US dollars, creating persistent demand for dollar liquidity. This arrangement, sometimes described in academic literature as a form of monetary privilege, has underpinned aspects of U.S. financial flexibility. However, historical data also shows gradual diversification. Several major energy producers and consumers have experimented with non-dollar settlement mechanisms over time. While these efforts have not displaced the dollar's central role, they have incrementally reduced exclusivity. Analysts debate whether such shifts represent experimentation, hedging behavior, or early-stage systemic change. From this perspective, Venezuela's significance may lie less in its current production levels than in its reserve base and symbolic role. Countries with large undeveloped reserves have historically functioned as signaling cases. How they price, finance, and integrate those reserves can influence broader expectations. Another contextual factor is the expansion of Chinese trade and infrastructure engagement across Latin America. Over the past 2 decades, trade volumes have increased substantially, accompanied by investment in ports, logistics, and financing. In historical comparison, such economic integration often precedes political influence, even when not explicitly framed as such. This does not necessarily imply zero-sum outcomes, but it does alter bargaining dynamics. When states possess alternative trade partners, their responsiveness to pressure from any single actor tends to decline. This pattern has been observed repeatedly in post-Cold War economic realignments. Within Venezuela itself, governance structures complicate post-intervention scenarios. Historical cases suggest that removing or isolating a single leader rarely dissolves entrenched political military networks. Systems built around distributed control of resources, patronage, and security functions often persist beyond leadership changes. From a comparative standpoint, countries where military and economic authority are deeply intertwined have tended to experience prolonged transitional uncertainty after external shocks. Outcomes have ranged from negotiated reconfiguration to fragmentation and prolonged instability. International responses also warrant attention. Historically, interventions perceived as coercive rather than consensual have often accelerated interest in alternative financial architectures among third parties, even those not directly involved. Risk perception, rather than ideological alignment, frequently drives diversification behavior. Recent initiatives to develop non-Western payment systems, currency swap arrangements, and alternative settlement platforms are sometimes interpreted as insurance mechanisms rather than outright replacements. Their effectiveness remains debated, but their proliferation indicates demand for optionality. From this analytical standpoint, the Venezuela operation can be interpreted as carrying multiple potential consequences, some aligned with stated objectives, others less so. It may reduce certain short-term constraints while increasing longer-term strategic uncertainty. Several broad scenarios are commonly discussed in policy analysis. One involves negotiated transition, where existing institutions are partially retained and external actors coordinate reconstruction and investment. Historically, this has required sustained multilateral engagement and internal consensus. Another involves fragmentation, where competing centers of power emerge and economic recovery stalls. Comparative cases suggest this path carries elevated humanitarian and regional spillover risks. A third involves extended great power competition, where external actors support parallel economic and political structures, turning the country into a long-term arena for influence rather than stabilization. None of these scenarios unfold cleanly, and historical precedent cautions against assuming rapid resolution. Markets often price optimistic outcomes initially, but prior interventions demonstrate that state reconstruction typically proves more complex than anticipated. Ultimately, the broader implication may be that the economic contest in the Western Hemisphere has moved from background condition to foreground driver. Energy resources, currency systems, and trade infrastructure now appear increasingly interconnected with security decisions. What remains uncertain is whether recent actions will reinforce existing systems or accelerate diversification away from them. History offers examples supporting both interpretations. What can be said with confidence is that structural shifts tend to outlast news cycles. While public attention moves on, states, institutions, and markets continue to adjust based on perceived risk and precedent. How those adjustments unfold will shape whether this episode is remembered as stabilization, escalation, or unintended acceleration of change. In that sense, the helicopters may represent only the opening moment. The more consequential developments are likely to occur quietly through contracts, currencies, alliances, and risk calculations made far from the cameras.